Good evening. Please come to stock exchanges abroad. Yesterday we have covered National Stock Exchange, Bombay Stock Exchange, two important stock exchanges in India. And internationally we will discuss few of them. Actually we have covered them in our first chapter in detail, chapter 1. So therefore today we will just go through it little quickly. With the increasing globalization and liberalization, the prices of the security on Indian stock exchanges are influenced by the stock exchanges abroad. So if New York Stock Exchange, Nasdaq, they have fallen, do you think BSC, NSE will also fall? The chances are that yes, even the BSC, NSE may be affected. Even BSC, NSE may be affected. So now you can say all stock exchanges are integrated. Some major event in one market can affect the other market also. So some knowledge of other stock exchanges are also necessary. So first you understand a very popular stock exchange called NYSE, New York Stock Exchange, was established more than 200 years ago in 1792. NYSE is the world's foremost security marketplace. So it's one of the most famous and highest volume of trading in NYSE. And that street is also very famous called Wall Street. Okay, like Bombay Stock Exchange has the Dalal Street. Each day on the NYSE trading floor, an auction takes place. So here still that open cry system is there, or maybe now they have stopped. Open bid and offers are managed on the trading floor by exchange members acting on behalf of the institution and individual investors. So this note suggests that buy and sell order for each listed security meet directly on the trading floor in the assigned location. Why the NYSE still has that open outcry system, that is the traders will come personally, physically and do the trading because they want to maintain the convention. They want to maintain the convention. It's not that they can't afford, but that convention. So they have specified locations where the trading is done. Prices are determined through demand and supply. Stocks buy and sell orders funnel through a single location, ensuring that the investor, no matter how big or small, is exposed to a wide range of buyers and sellers. This is NYSE. Now we'll quickly go through NASDAQ. I suggest you read also chapter 1 along with this chapter, where the details of NYSE and NASDAQ is also given. So read both together. So if you have a question in the exam, search for both the places. NASDAQ is more into technology stocks. Okay. The full form of NASDAQ is National Association of Software Dealers Active Quotation, or Securities Dealer Active Quotation, and it is known for growth, liquidity, depth of the market. The world's most powerful and forward-looking technologies. So these are the features of NASDAQ. All these make NASDAQ choice of the leading companies worldwide. So all big companies on earth, they are either listed or they want themselves to get listed on NASDAQ. And mostly the technology companies are listed here. Since its inception in 1971, when was it started? 1971, NASDAQ has steadily outpaced the other major markets to become the fastest growing stock market in the US. NASDAQ is a screen based market, that means online trading. computer based. No physical space where you have to go and buy and sell. Operating in an efficient, highly competitive electronic trading environment. So just like in India we have BSE, NSE, now it is Nasdaq also. Electronic trading. You can do trading on your computer or mobile phones. As the market for Nasdaq's largest and most actively traded securities, the Nasdaq market lists more than 4,000 securities. These are some statistics that there are 4,000 and above securities are listed. Now, which companies can get themselves listed on the Nasdaq? There are strict rules, strict parameters. It should have good financial condition, market capitalization, and it should have a very high corporate governance standard. Then only they will select the candidate for listing on the Nasdaq. Nasdaq's national market companies include some of the largest and best known companies in the world. So Apple, Microsoft, okay, Facebook, Google, they are all listed on Nasdaq. Nasdaq is different from NYSE because it does not have the traditional floor based stock trading. Floor based means people assemble in a hall, big hall, and they do the trading. Nasdaq does not have like that. Nasdaq has no single specialist through which transaction pass. Nasdaq's market structure allow multiple market participants to trade stock through a sophisticated computer network linking buyers and sellers from around the world. It's the power of technology. World over, people can trade in Nasdaq. You don't have to go to a particular place. This computer system is very powerful. They can handle lakhs of transactions every second. Together, these participants help ensure transparency and liquidity also, because millions of people are participating. So there is a transparency and there is liquidity for the company stock while maintaining an orderly market and functioning under tight regulatory controls. US market is highly regulated, that you know. Yes or no? So therefore Nasdaq is very popular among investors. Transparency, liquidity, strict regulation protect the interest of the investors. Now let us quickly go through LSC. What is LSE? London Stock Exchange. Its history goes back to 1760. It's a very old stock exchange. When 150 brokers kicked out of the Royal Exchange for rowdiness, formed a club at Jonathan's Coffee House to buy and sell. 150 brokers were there who were kicked out of Royal Exchange. They formed a club at a coffee house called Jonathan's Coffee House to buy and sell shares. In 1773, after that is 13 years, members voted to change the name to Stock Exchange. So this Jonathan's Coffee House where the trading was done, it was changed to Stock Exchange and 2000 shareholders voted it to become a public limited company. And thus London Stock Exchange was formed. Dealing in shares is conducted via an off-market trading facility operated by a company called Kazunov and Company. They are the technology provider. Services provided by London Stock Exchange. To whom London Stock Exchange provides services? It provides services to companies and investors. What is the service? What are the services provided to the company? Yes, it provides a number of markets which allow companies, large and small, to raise capital. That is the function of stock exchange. So companies can raise capital and a wide range of services to increase the profile of the companies. Then second is trading services. Second service is trading services. It gives market users access to well-developed trading environment with a proven record of stability and flexibility. Okay. That means investors are confident that this is a trading environment with a proven track record. Things would normally not go wrong. No fraud, scam. Okay. Normally the things will not go wrong. Next is information service. It provides high quality real time price information to market users worldwide, as well as historical and reference data. So all information that you want to know about a stock, what was the price in the last 6 months, 1 year, plus any historical data that you need is provided. This will help the investor to take an informed decision. And supporting these activities, the exchange regulates the markets to give protection to investors and companies and to maintain its reputation for high standard and integrity. So regulation wise also the standard are very high. It gives safety to investors and companies. In addition, in partnership with others, it helps to track the performance of the market through various indices. What do you mean by indices? It is index, market index. So if you want to know the performance of market in general, there will be an index. Like in India, we have BSE Sensex. For London Stock Exchange, what is that index known as? I think FTSE. Okay. Or if you want to know the performance of technology sector, there are technology index. If you want to know the performance of software companies or say pharma companies, there are pharma index. So they also give you performance for certain group of industries also. Okay. So this was some brief discussion about London Stock Exchange. In the first chapter, we had also covered Hong Kong Stock Exchange, Singapore Stock Exchange, Luxembourg Stock Exchange also. So those will also form part of this chapter. So when you read the stock exchange abroad, combine these two notes and make the maximum information at one place. Now there is a paragraph number next which says characteristics of stock exchanges in India. You are a student of finance. You have a lot of money earned in stipend. So you should know how the stock market functions. So today a lot of things you will learn. Maybe you can use this information for your own gain. Stock exchange in India operates with due recognition from government under the SCRA 1956. Stock exchanges are recognized under this law. Corporate members of stock exchanges has also been introduced lately. So now stock exchanges are corporatized, demutualized. It works on the principle of corporate entity. There are shareholders. Okay, there is a board. There is a president who is like a CEO. Okay. There are at present 20 stock exchanges in India, but only 2 of them are now well recognized, BSE and NSE. Others are almost not functioning, or they do some other activity, but not the usual share trading. Okay. A stock exchange is typically governed by a board. Now there is a board also consisting of directors. It's a corporatized entity. Some members of the board are nominated by the government, because government also wants to oversee the functioning of stock exchange. It's written there. We'll see how many can be nominated. Government nominees include representatives of the Ministry of Finance as well as some public representatives who are expected to safeguard the interest of investors in the functioning of the exchange. So how many nominees are there? Not mentioned. One is from that Ministry of Finance and other are some well-known public representatives. Their objective is to protect the interest of the investor. And the board is headed by a president. The board is headed by a president who is an elected member, usually nominated by the government from among the elected members. The executive director, who is appointed by the stock exchange with government approval, is the operational chief of the stock exchange. Head of the board of director is called the president, okay, who is nominated by the government from among the elected members. An executive director is appointed by the stock exchange, who is the operational chief of the stock exchange. One student has asked how many nominee directors are there. It's not specifically mentioned here. In BSc we have come across 3 members. 3 members are nominated in paragraph 6.1. Is it 3 or at least 3? At most 3. On a higher side, it can be 1, 2 or 3. So maximum 3 members can be nominated members. Okay. Next paragraph. What is the duty of this executive director? His duty is to ensure that the day-to-day operations of the stock exchanges are carried out in accordance with the rules and regulations governing its function. SEBI has been set up in Mumbai by the government to oversee the orderly development of stock exchanges in the country. This is basically an overall view of how the whole stock market works in India. Many points will be repeated here. All companies wishing to raise capital from public are required to list their securities on at least one stock exchange. So if you want to raise funds to IPO, you have to also get yourself listed at least in one stock exchange. Thus, all ordinary share, preference share and debentures of publicly held companies are listed in one or more stock exchange. Stock exchange, what do? They facilitate trading in the security of public sector and government security. General knowledge about stock exchange. In fact, all these points which we read were covered in one or the other paragraphs earlier on. Now the next is functions of stock exchange. This you should know. What is the function of stock exchange? First is that stock exchange is a market where investor can buy and sell securities. This itself is a function. It provides a platform where the buyer and the seller can come. And because of this, the first point which says it provides liquidity and marketability of security. This is the most important function. Had there been no stock exchange, liquidity in the stock will not be there. Marketability will not be there. That means people will not invest in the primary market also. So no new company will be able to raise funds in the market. Because stock exchange is there where people can buy and sell security on any working day, the stock market or the primary market also develops, overall economy develops. It also provides investor the opportunity to change their portfolio. It also provides investors the opportunity to change their portfolio as and when they want to change. Okay. Let me suppose you want to reduce the exposure to a particular stock. You can sell in the market. You want to increase the exposure to a particular stock. You can buy. Okay. So marketability of security is possible only because of stock exchange. Right. This you will be able to write. Second is stock market is a place where prices of the securities are determined. Large number of people are participating. Every day, lakhs and millions of people are sitting on their terminal and buying and selling the stocks. So will the price be rigged? Rigged means manipulated. Chances are less. If there are few persons only in the market, then the prices can be manipulated. It's a most competitive market. It's a most competitive market. At the same point of time, for the same stock, lakhs of people are there to buy and sell, and therefore prices are fairly determined. Due to nearly perfect information, active bidding takes place from both the sides. This ensures fair price to be determined by demand and supply. That is why whenever suppose mergers and acquisitions have to take place, A Limited wants to acquire B and B is a listed company. What is the price A Limited will pay to B Limited? They will find out what is the price in the stock market. They will take average of last say 6 months. That will be the basis, the starting point for the negotiation. Depending upon how much stake you are buying, you will either pay more premium or less premium. But you can't ignore the market price. If market price of B is 300 rupees on an average, you can't say no, we'll pay you only 100 rupees. We will say okay, Tata, bye bye. I can better sell the share in the market where investors are willing to pay 300 rupees. And it's not one investor, it's the whole stock market. So that is the reason the stock market prices form the basis for decision making in many acquisition decisions. Then next is source of long-term fund. Company can issue shares, debentures, bonds, which will later on traded in the stock market. And therefore it acts as a source of long-term funds. Okay. In primary market, you will issue instrument. Suppose you want to raise funds by issuing debenture, which has a 5-year maturity. Still, it is purchased by investor community because it will be traded in the secondary market. So even though the nature of the instrument may be long-term, but for the investor there is a liquidity because there is a stock market where he can sell. Okay. And because the stock market allows it to be transferred, even though the security is a long term, still it is invested by the investor community. Otherwise, why will people invest in equity share? Because once he invests the money, he is not going to get it back. So they are traded and change hands from one investor to another without affecting the long term availability of funds to the issuing company. So that is one important function. Even though the trading takes place daily, but companies can raise funds. Stock market helps in capital formation. One is savings of the people are channelized into productive investment. But you will say that is a function of primary market. I agree. But then in primary market, people invest knowingly that this is going to be traded in the stock market at a later date once it is listed. Okay. Those investments are made in productive areas infrastructure, factory, services, and therefore overall GDP of the country will increase. Otherwise, savings will remain idle only. The savings of the community are mobilized and channeled by stock exchange for investment into those sectors and units which are favored by community at large. It is the preference of investor for individual units as well as industry groups which is reflected in the share price that decides the mode of the investment. If particular industry is expected to perform well or is performing well, more and more investments are channelized into those industries. So it is an incentive for the companies also that they should perform well so that they will get the funds from the investor community. If the stock market rises, the wealth of the shareholder increases. That is also capital formation. Okay. Some exchanges render this service by arranging for the preliminary distribution of new issue of capital offered through prospectus as also offer for sale of existing security in an orderly and systematic way. So stock market basically channelizes savings into productive investment which helps in capital formation. So next is stock market ensure that the various requisites of listing such as offering at least the prescribed minimum percentage of capital to the public. So they also ensure that all necessary regulations are complied with. Otherwise, they will not allow the company to be listed. Minimum public subscription rule have to follow. Subscription list should be open for that minimum number of 3 days. Then making provision for receiving application for at least at the prescribed centers where the investor can go and take the forms, fill the forms, and allotting the shares against application on a fair and unconditional basis. Even that they ensure that you don't allot shares to your own persons. It is on unconditional basis, unbiased basis, are duly complied. So this functions helps in bringing more investor into the stock. Next function of stock exchange. Members of stock exchange also assist in the flotation of new issues. Have I explained that? Members of stock exchange also assist in the flotation of new issues by acting as brokers. If new company wants to raise funds, where will you go? Stock exchange. But then stock exchange will ask its intermediaries like brokers who are in touch with their clients, and then these brokers will try to persuade, convince their clients to purchase the share. Brokers have their network all over the country. The stock market helps the new issues also through brokers, underwriters. Stock exchanges also provide a forum for trading in right shares of company already listed, thereby enabling a new class of investor to take up a part of the rights in place of the existing shareholders who renounce their rights for monetary consideration. In case of right issue also, a new class of investor can purchase the share, of course subject to the rights are renounced in their favor. So does it help the new company? Does it help the existing companies? So these are the functions. And the last but not the least, it reflects the general state of economy. Reflects the general state that I think yesterday also we had said. The stock market is booming. What does that reflect? Economy is growing in general. The stock market is falling, it is in depression, index are falling day by day. It means the economy is also not performing well. So it is like an economic indicator. It is a barometer of economic performance. In some books they use the word barometer of economic performance. Okay, just like a barometer is used to measure what? Pressure or something. Temperature. Your thermometer used to measure temperature. So this is like a instrument which measures the performance of economy in general. It indicates the general state of economy to all those concerned who can take suitable steps in time. Even it is useful for government. If the market is going up or down, accordingly government's policies are also decided. The government takes suitable monetary policy we have discussed. Okay, credit policy, supply of money, interest rate, CRR, SLR, these are monetary policy. And fiscal steps means taxation, subsidy, expenditure. Okay, government takes necessary steps to uh, again improve the status of the economy. Again, the stock market can give them an indication. After learning the functions of stock exchange, now you will find something very interesting. Basics of stock market index. Bombay Stock Exchange has, say for example, more than 4,800 shares listed, around that number. How do I know whether the stock market today has performed well or not? Do I need to look at all those shares? Or do I need to look at only their representative? Representative? Yes or no? So that representative is called Sensex. It's the index of Bombay Stock Exchange. Okay. And the purpose of constructing an index is to get an overall idea, general idea, that whether the stock market as a whole in general has gone up or has come down. If stock index has gone up, we will say in general the market is going up. If stock market index is coming down, we will say in general the market is falling. But it does not mean that all the stocks have gone up. Some may have gone down also on that. But most of them in general have gone up. Index is the representative of the entire stock market. Okay. The movement of the index represents the average return obtained by the investors in the stock. In portfolio management chapter, we have used this market return concept, RM. That is, in general, how much rate of return the market has generated during the year. And for that, normally we take the main index of that market. Like for example, we say if Sensex was 30,000 at the beginning of the year points, then 33,000 at the end of the year. So the market has given a return of 10% during the year. In general, market has given a return of 10%. A base year is set along with a basket of base shares. So how is index calculated? For every index, they have selected some base year. Like for example, for BSC, the base year was some 1979 or something. Okay. And for NSC, the base year was something like 1994 or something. So they take a base year. Okay. Base year index will be normally 100. But in case of Nifty, the base year index was 1000 because it started quite late. So we gave them starting point 1000. Now what they will do, they will calculate what is the market capitalization on this date. Base year, market capitalization. Suppose the market capitalization is 30,000 of all the shares, or let us say 3 lakh. So if the market capitalization on the base year when the index started was 3 lakh, we gave the value of index as 100. Just like in your income tax act also, there is an index. But let us say after many years, now the market capitalization is 30 lakh. So what will be the index now? Index will become 1000. It means the market capitalization has increased by 10 times. So the value of the index will become 1000. So you answer, if the market capitalization becomes say 4 crore 25 lakh of the companies which are listed, which are included in this index, my question to this batch of very talented students is, what will be the index now? Take calculator. It is just a simple arithmetic. In base year, they took the market capitalization, gave it as a value of base value of 100. And now as the market capitalization will change, the index value will change. How much you got? 14,000? 141? No. It should have been 5 digits. Just try. 14167? Yes. Mathematics. No problem. It happened. You are tired now. You have done lot of articleship. Your articleship stress is reflecting on your calculation. You are making mistake in school level arithmetic now. That means you are working extraordinarily hard in your articleship. Okay. The change in the market price of the share is calculated on a daily basis. Every day they calculate index. What is the closing index yesterday of Sensex? 33,000. You are so far away from the actual figure. Anyway, from today you start tracking the index. Saturday, Sunday market is closed, so it will not move. But from Monday to Friday, it changes. The changes in the market price of the share is calculated on a daily basis, so that the investors know whether yesterday and today the market has gone up or come down. The shares included in the index are those shares which are traded regularly in high volume. So they choose some of the best shares which are listed. Like Sensex has chosen 30 best shares. Sensex have chosen 30 best shares. Nifty have chosen Nifty 50. Nifty has chosen 50 best share, National Stock Exchange Index. So your homework is, I have not written purposefully. You have to tell me tomorrow or whenever the next batch will be there, next class, which are the 30 shares in the Sensex and which are the 50 shares in Nifty. Normally these 30 will be there in the Nifty also, but there may be 20 more shares. And these are, you can say, the best of the best companies in the country. Like for example, you will find there TCS, Reliance, Infosys, HUL, Maruti, MRF, and there are many more you have to find, Larsen and Toubro. Okay. Practically what they do, they try to select securities from different sectors. Okay. That means in the index there will be some share which will reflect automobile. So you will have Maruti, Bajaj Auto, or Hero, maybe. Some will be from metal sector like Tata Steel. Some will be from pharma sector, Dr. Reddy's Laboratory, Sun Pharma. Okay. Somebody may be from infrastructure, L&T is there, Reliance is there. From banking sector you have SBI, ICICI, HDFC. Okay, so that you know overall performance of the country of the stock market. If they choose only from a particular sector, that's called sectoral index. So there are sectoral index also to check the performance of a particular sector. So you have banking sector index, technology index, pharma index, PSU index means which track the performance of PSU company, infrastructure index. Okay, who selects this share? There is a committee of the stock exchange. Okay, which has representative of SEBI, RBI, government, and stock exchange. They decide which shares will be included in the 30 or 50 shares. Do they revise this list also? Yes. Periodically they see which company is not required in the index now, so they will remove it. Which new company needs to be added in the index, so they will add. So that periodic revision is done based on the performance. New companies will be added, some will be removed. But the convention is that for Sensex always there will be 30 shares and for Nifty there will be 50 shares. It is like a parliament. Okay, so you have billions of people and these are their representatives, but the total number of MPs remain the same every year. If new MP has to come, some old MP has to go out. In case the trading in any share stops or comes down, then it gets excluded and another company share replaces it. Each stock exchange has a flagship index, main index. Like in India, the two most popular indices are of BSE and NSE, which are popularly called Sensex of BSE and Nifty of NSE. And outside India, Dow Jones, that is, I think, New York Stock Exchange, FTSE, London Stock Exchange. Okay, then Tokyo Stock Exchange, Nikkei, NIKKEI, that is their stock exchange index known. Then in Hong Kong they call Hang Seng, Hang Seng. Pakistan I don't know, I'll find out. In Karachi Stock Exchange also has some index. Okay, so each country has a major stock exchange index and they keep very interesting names also for this index, so it becomes quite popular, becomes a brand in itself. Now next is paragraph, next concept behind fluctuation of index. Those who don't know much about stock market, they always think why this stock index fluctuate every day, every minute. Whenever you open some television channel during daytime, even though it may not be a finance related channel, but they will disclose index value on the left corner or right corner, bottom side. Is it right? Even in the general news channel also they say today Sensex closed at 33,730 points, etc. So a lot of people always wonder what is this Sensex. Those who don't know, you may also be wondering. Now you know, you are a student of such a big course, financial course. But this index is basically, as I said, representative of the stock market. As the market capitalization of those shares will change, the index value will change. So every day the share prices are changing. So every day the index will also change. If share prices increase in general, total market capitalization will go up. Therefore index will rise. The share prices fall, the market capitalization will fall, the index will fall. So that is why index fluctuate. Stocks are valued by discounting future earning of the company. Therefore, stock indices reflect expectation about future performance of the company listed on the stock exchange or performance of the industrial sector. When the index goes up, it indicates that the market is thinking that future return will be higher than they are at present and vice versa. That means the share price will rise, index will go up. Stock prices are sensitive to company specific news, country specific news, which include budget, election, government policy, wars, and so on. Okay. Suppose the news comes about a company that this company's CEO has been arrested by the government on account of fraud. So what will be the impact on the share price? Decrease. That stock is a part of index. So what will happen to the index? Index will fall. Then in the newspaper today it was written, GDP growth rate has declined. So the moment this news comes in the market, the prices will fall. Index will fall. Okay. So somebody will say in USA there is a war. Al-Qaeda has attacked USA. It will affect stock market. Share price will fall. So any news relating to company, industry, country, international, nowadays have a bearing on the stock market prices. And therefore the stock market fluctuates a lot. You can't really help it. Okay. We call it as a market risk in finance. Which risk? Market risk. That is, market will fluctuate due to large number of parameters over which nobody has control. Is it right? Non-diversifiable risk in portfolio management. Market risk is a non-diversifiable risk. Next part is paragraph next says computation of index. Okay. I have prepared a 1-hour video also on how the index is computed, which you can see on YouTube. Okay. How Sensex is calculated. But today I'll just briefly discuss how index is calculated. But if you want to study in detail, then you can refer that YouTube video. Link. You just search my name, you will find. You can say Sensex by CA Vinod Kumar Agarwal. That's it. It will come. So following steps are involved in calculation of index. Actually, it's very easy, as people think it is not very difficult at all. First is compute the market capitalization of each individual company. Can you do that? How do you calculate market capitalization? Number of share into market price of the share. It's called market capitalization. Then compute the total of all the shares which are forming part of the index. That also you can do. Suppose there are 30 shares, A, B, 30 shares. You multiply their number, market price, market cap, take the total. So this is the market capitalization as at a given point of time. Okay. Next is compute the index of the next day. Require that the index value and the total market capitalization of the previous day and is computed as follows. Okay. There is a formula. Formula is not appearing. I'll write. Index value today will be equal to. There is a question in the exam also on this for 1 mark. That question I am going to take. From this line there was a question. Index value today will be equal to index on previous day into market capitalization of today upon market capitalization of previous. So, okay, what will happen now? If the market capitalization today is more than market capitalization of yesterday for the same stock, index will rise. The market capitalization of today is less than the market capitalization of yesterday, the index will fall. So this way every day you can calculate the index. Or one more formula is there which your institute has not given, which I had explained to you earlier. You will take this arithmetic, okay, base index 100 and base market capitalization, whatever was the market capitalization when the index was formed. Let us say, for example, say 3 lakh. Now today the market capitalization is suppose 32 crore 50 lakh or something. What will be the value of the index today? Is it right? So using this arithmetic can calculate the index today. Actually it is happening the same. In previous method what is happening? Every day you are calculating the index and using that as a basis for the next day. 10833 point. Okay, no, this is enough. Only for understand. You have no further use of this 0.33 in life. Okay. So depending upon how the data is given to you, if base index is given and base market capitalization is given, then just calculate the proportionate amount. If previous index, previous capitalization, current capitalization is given, then use that formula printed in the books. Previous day index into today's market capitalization upon yesterday's market cap. Okay, understood the logic? But there is a problem here. What is that problem? I will tell you that this note tells you about market capitalization. Practically what they've started doing, they don't use market capitalization. Then what do they use? Free float market capitalization. To write one note there below, some space is there, it is there. Now index is based on free float market capitalization. Now index is based on free float market capitalization. Now index is based on free float market capitalization. That is market capitalization of shares. That is market capitalization of shares held by non-promoters group. Held by non-promoters group. That is market capitalization of shares held by non-promoters group. Write one example to understand. In your note continue, total number of shares is 1 lakh. Promoter holding 20,000. So what is the non-promoter holding? This you should know that nowadays both Sensex and Nifty are based on free float market cap. So non-promoter holding is 80,000 shares. Market price per share, suppose 200 rupees. So therefore free float market capitalization will be 80,000 into 200. Is it 16 lakh? One more zero. Total 6 zeros I need. 1 crore 16. 1 crore 60. This will be now used in the numerator and denominator. Because the logic they are saying that those shares which are held by promoters are not available for trading. Are they available for trading? No. Don't include that in the index calculation. So world over they have moved to this free float market capitalization methodology for index calculation. So therefore those companies where promoter stake is very high, they will have less weightage in the index calculation. That means they will affect index less. And those share where non-promoter holding is very high, they will have a more effect on the index movement. Now, two more points are printed. It should also be noted that indices may also be calculated using the price weighted method. Here the share price of the constituent companies forms the weight. And that is just a theory question. Practically now it is all free float market capitalization. They are saying you take the average of prices. But average of prices cannot be taken as a base now. However, almost all equity indices worldwide are calculated using the market capitalization weighted method. In fact, here also you can further say free float market capitalization weighted method. Okay. Now I am going to test your understanding of last 1.5 day. Answer itself has come. Dash were required. No, that is wrong. Dash were required to make payment or give delivery within 2 working days of the payout day. Who are required to make payment or give delivery within 2 working days of the payout day? Depository or custodian or broker or banker. Who has the responsibility of giving payment or give delivery within 2 working days? Custodian, depository, banker, broker. Stock exchange will recover money from whom? Broker. Ultimately, broker is responsible for the act of his client. So broker has to ensure that the payment is made in case purchase is done. Securities are delivered in case the shares are sold. So the answer was broker. Okay. One more question for you. The index value of a particular date is calculated as. Read the 4 options and tell me the right answer. This question I have taken from either the ICI model test paper or exam paper. Okay. Model test paper or exam paper of ICI. So this now, just now you have learned, index will be calculated as index of the previous day into total market capitalization for current day upon total market capitalization of previous day. That is the right answer. Okay, one more chance. How many companies are included in Sensex? 30. Answer is also ready-made available. Now, when was Nifty established? 96 or 94? I think the options itself are wrong. Just check your notes. 92. Huh? Huh? But the establishment was done before. So 92. What is done in the stock market? Question from KBC for 1000 rupees. Okay. Trading, singing, dancing, rocking. Trading is done in the stock market. This is from your May 2018 exam. 3 mark question. But this is a subjective question. S&P BSE Sensex was 32840.50 on a certain day. On the same day, Nifty 50 was 10,287.70. Explain the vast differences between the numbers and the underlying concept. Yes, these are two different indices. Started at different point of time. They have a different base year, and therefore the two numbers are different. They can't be compared. Okay. Sensex is a very early starter. 1979, around that time Sensex started. Whereas this construction of Nifty started around 1995. Therefore, there, of course, by that time the Sensex has moved far ahead. To reduce the gap, they have started this with 1000. Imagine if this was 100, today the gap would have been even much more than that. So the answer is, you want to write the answer, right? This you will get in the model test paper also, May 2018 exam paper also. But still, if you want to write, you can write little fast. First, write down the question. Small question. You can simply write BSE Sensex was 32,840.5 on a certain day. So you will get an idea what kind of question they ask. There is no direct answer of this question in the notes. Have you found any answer which can directly lead to this answer? No. On the same day, Nifty was 10,287.70. Explain the vast difference between the numbers and explain the underlying concept also. Explain the vast difference between the numbers and the underlying concept. Okay. For 3 marks you have to write. Now this question has been asked in the exam, but it has nothing to do with that case study which was presented. Okay, it's a general question. Today also you can answer as a student of finance. So the numbers are, write down, the answer is the numbers are leading market indices. The numbers are leading market indices. The numbers are leading market indices. A market index normally, a market index is normally computed by computing market capitalization of select number of shares chosen. Market capitalization of select number of shares chosen to represent market movement. To represent market movement. Next paragraph you can write. So first paragraph you are giving a general introduction of the question. Second, S&P BSE Sensex was set at 100. Set at 100 on 1st April 1979. And consist of the market cap weighted index of 30 chosen stocks. Market cap weighted index of 30 chosen stocks, whereas the Nifty 50 Nifty 50 consists of 50 company stocks, 50 companies stocks listed on the National Stock Exchange. The base period is November 3rd, 1995. November 3rd, 1995. And the base value has been set at 1000. Since the base values are very different, we have a big gap in the updated values. On every trade date. The last paragraph is very interesting. However, daily percentage increase or decrease of the indices are almost the same. Percentage change would always be the same. Okay, if you carefully observe the index now, every day you just read the newspaper, by what percentage Sensex have changed. So let us say they will say 1%. So Nifty will change by say 1.1% or 0.9%, indicating the general market movement. It won't happen Sensex have gone up by 3% and Nifty has gone down by 5% on a given day. It won't happen because prices are usually similar in both the stock exchange. There may be some difference, but that is not enough. Otherwise, people will buy from one market and sell in another market. Have you noted the answer? This way they expect you to write the answer. So from this example, what is the lesson you have learned? A direct question can be asked which is not related to your given case study. It is based on your general understanding. Second thing you have learned, question answer may not be directly available in the notes. Even if you carry so many books, such questions will require your own understanding. One student has a query. Which figure? 100 is the base number. Generally, there is a base number for every index calculation. Like in your income tax capital gain calculation, the base here has 100, and then from 100, what is the change? Nothing mentioned. No, don't worry, now understand. It will come in some other chapter or sometime. You just have to know it. BSc Sensex is a part of syllabus. Now you know everything about BSc Sensex. You can't write to the institute that this is not printed in ICI matter. They are saying we are allowing you to bring your own notes. Okay, so come on, next paragraph. Risk management in secondary market. The stock exchanges have developed. Now here risk management means how the stock exchange itself ensures that the interest of the investor is protected. There is no undue loss to the investor. There is no fraud, manipulation in the stock market. Okay, not from investor point of view, but from exchange point of view. What checks and balances, what controls, what are the various aspects which they have considered to ensure minimum risk to the investor. The stock exchanges have developed a comprehensive risk management mechanism to promote a safe and efficient capital market. Because if the risk is unnecessarily very high, the investor will not be attracted toward the stock market. Is it right? If you purchase the share and if you don't get the delivery of the shares in a given point of time or within the specified time, you will lose confidence. You sell the share and if you don't receive money in a given time framework, you would lose confidence. Then again there must not be too much of volatility also that you lose all your money on a given day. So that is why there are concepts like circuit filters which prevents too much of volatility and loss on a given day. So they will stop the trading, which I am going to discuss below. Circuit filter, circuit breakers. So this includes, first of all, those who want to trade in the stock exchange, deal through stock exchange, they have to follow the rules and regulations. So rules and regulations for broker member is there. Setting up market surveillance system to curb excess volatility. That means there is a surveillance system. They have the softwares which will checking which stock is moving very fast, okay, where the volatility is very high, what is the reason, and they might even stop the trading of that share. Okay. Then creating trade settlement guarantee fund. Creating trade or settlement guarantee fund to ensure timely settlement even if a member defaults to deliver securities or pay the cash. So this is very good. There is a trade settlement guarantee fund. If person is not able to pay, if a broker is not able to pay, at least the exchange will first honor that transaction. Later on they will recover or do whatever necessary step they have to take. But at least the one who has bought the share, he should be given delivery of share. The one who has sold the share should be given the payment. So therefore this is done even if a member defaults to deliver security or pay cash in the given time framework. Then now the stock exchanges have set up a clearing corporation. It's like a back office, okay. Some discussion of clearing corporation is on the next page. We'll discuss later. So setting up of a clearing corporation to guarantee financial settlement of all trades. So they take shares from one party, give it to another party. They take cash from one party, give it to other party. That is in simple words you can understand. Their task is to ensure that the one who has sold the share, he delivers the share and receives money, and the one who has purchased the share, he pays money and receives the delivery of share, and thereby reduce credit risk in the settlement system. What is the meaning of credit risk? You have learnt in accounts batch also, FR. Credit risk means risk of default. Risk of default. There is no default. Those who are doing trading in the stock market, one student says, my father is a stockbroker. You have to find out from him, has it ever happened that somebody has purchased the share and he has not received the delivery in his demat account? Never happened. Somebody has sold the share and he has never received the payment. There is no credit risk. Yes, you have to settle the account. So therefore the credit risk is not there. And this is through this clearing corporation mechanism. The risk management structure of a market, secondary market or stock exchange has been discussed in detail in the following paragraph to enable students to have a good grasp over the nuances of secondary market. Okay, so now in the next few paragraphs, you will see trading rules and regulations. And under that, you will again understand how the stock exchange is trying to prevent the risk of default. So first is strict rules and regulations have been framed to prevent unfair trade practices and insider trading. Have you heard this word insider trading? those who have knowledge about the company which can have an impact on the price, who work inside the company in some or the other capacity, and they use that information for personal gain at the expense of the other shareholders. This is called insider trading. Insider person is trading in the share of that company and making gains. So in India, it's a punishable offense. Punishment is 25 crore rupees. Or how many times of the profit? 3 times. Whichever is higher. It's like a deterrence. What is deterrence? It will prevent the corporates, or at least those who work in the corporates, to try to make profit from insider. Even the auditor is an insider because he gets all the information. He gets to know the profit of the company before the results are published. He cannot disclose it to his friends or relatives. In big companies, they do not allow to do audit of those companies in which you or your family members are holding the shares. Even the article clerk is not allowed to go for some voucher checking also if he or his family members are holding shares of that company. Is it right? So don't do this. In India, you can pay penalty and maybe you can escape, but in USA, they will put you behind jail also. Okay. Stock exchanges impose different types of margin. Now, in this chapter, we will not discuss different types of margin, but in SFM batch, you will study initial margin, maintenance margin, mark to market margin. Okay. So, margins are taken from the members, brokers, so that in case if he defaults, his margin money will be used to make the payment. On the brokers for individual stocks, depending upon the exposure taken by this broker in the stocks, both on ownership basis and on the behalf of their client. So margins are basically a very useful mechanism to ensure that in case if the brokers default, the exchange has sufficient money to make the payment. These margins are collected to prevent brokers from taking market positions in excess of their buying capacity. They are also used to settle any amount due to the stock exchange, clearing corporation and traders in case the broker faces any shortage of amount. So if you are not able to pay, your margin money will be forfeited or will be used to make the payment. These are the mechanism to reduce the risk. Further, there is a real-time monitoring of the intraday trading limits and gross exposure limits by the stock exchange. That means on the broker there are limits imposed. Within that limits only you can take the exposures. And there is an automatic deactivation of trading terminal in case of breach of exposure limit. Has it ever happened with you? You can increase or decrease the limits. How? By paying some amount officially or unofficial. So that your limits can increase. But if you don't increase, then it is deactivated. Has it ever happened? You find and tell me one person whose dad is having a trading terminal. He will tell us tomorrow whether any time his terminal got deactivated. Also, SEBI stipulated that stock brokers and sub brokers of one exchange cannot deal with broker and some brokers of the same exchange. Broker in same exchange cannot trade either for proprietary trading, means on their own account, or on behalf of their clients. However, they can deal with brokers and sub brokers of another exchange for proprietary trading only. Moreover, to ensure fair trading practices, SEBI has devised insider trading regulations by prohibiting insider trading and making it a criminal offense. SEBI is very strict on insider trading. Okay, and they impose huge penalty. They can put the offender behind jail also. To ensure transparency in the takeover process, even to ensure that takeover is fair, transparent, in the interest of all stakeholders, SEBI takeover regulations have been incorporated. Which good news is not a part of your syllabus, right? SEBI takeover code. Okay. To protect the interest of investor, SEBI takeover code is there. According to that, only one company can acquire a listed company. Now, one interesting thing you will learn is circuit breakers to curb excess volatility. This is another method to protect the loss of the investors. If you remember in 2009, chances are less you will remember, MMS became Prime Minister for the second time. MMS, Manmohan Singh. On that day, BSC Sensex had increased by 2110 points in the first few minutes only. Okay, because people were very happy. Second time Manmohan Singh became Prime Minister on a continuous basis. Intellectual person. And not only that UPA had a comfortable majority also. Which means there was high probability that it will last for 5 years. So stock market generally first wants to ensure that a stable government has come into the power and it will last, and again it's a good government in their view, then the market would go up. In my view, yes, in my view it was a good government because such a qualified person was the Prime Minister. Okay, who actually knows what he does. There are some Prime Minister who only for the sake of popularity do anything that they want. Okay, even without understanding how it might affect other persons. Okay, so market is smart. Okay, they understand this kind of persons when it becomes the Prime Minister, stable government, the policies will also be on a continuous basis. Continuous government means policy will also continue. Because the moment the government changes, the new government first few days, first few months, scrap the old policy. Then again impose the new policy. Even the old policy were good or bad, that is not their problem. Yes or no? And then come out with the new policy which will be a modified version of the old policy only. So first they will say no, Aadhaar is bad. But when they will come to power, they will come out with the same version. First they will say GST is bad. But when they will come to power, they will say GST is good. So the logic of this huge surge in the Sensex is continuity of a government which investor had trust. But now we are the supposed investor. If so much is the rise in the price of the Sensex, it is not good for the market. Because there are always two parties. One will gain, one would lose. If there is a call option, for example, what will happen to the writer of the call option, you can imagine how much loss he will suffer. He will not be able to bring the required amount of funds to cover his losses. Even his margin will not be sufficient. Those who have sold future, those who have sold index future, they would suffer huge loss. They will have to borrow money from the bank to pay the daily mark to market margin. They may not have money, they will default. So it will create a chain reaction in the market. That day they stopped the trading for the whole day itself. Stock market was closed for the remaining day, otherwise further volatility would have taken. So the idea is to protect the huge losses of the investor. So what do? They do the stoppage of trading. First, maybe for some hours, some minutes, sometimes for the whole day. First 45 minutes they halted, but again the market was just rising and rising. So they thought that let us close it for the whole day. Okay. So the activities or trading is terminated for some period or for the whole day. So it depends on two things. It depends on what is the percentage change in the stock price. Accordingly, they will decide for how many minutes the trading should be halted. It also depends at by what time the percentage changes have been done. If it is before 1 o'clock, the rule is different. If it is between 1 to 2:30 p.m., the rules are different. And if it is after 2:30 p.m., the rules are different. That is printed on the next page. But I hope you got some general idea. Circuit breakers is a temporary halt or suspension of trading in a particular stock or index for certain period of time. This move is basically why circuit filter to curb excess volatility in the stock market. It will cause huge damage, irreparable damage to the market, and some people may become complete bankrupt also. Circuit breaker is a temporary hold, this we have discussed. Two methods by which circuit breakers are practiced. One is suspension of trade in a security or index for a certain period, and second is for the entire trading day. In the first option, trading activities are suspended for few hours, like you will see in the next page, 1 hour, half an hour, 1.5 hour, to enable the market to settle down. Okay, let people breathe, understand what is happening. Otherwise, one after the other, people just follow the herd. Others are selling, everybody starts selling. Share price will further fall. Again, more people will sell. Again, it will fall. And same thing happens when prices start rising. Everybody jumps into that bandwagon for buying the shares only. The prices will keep on rising. So when the trading is halted, at least you have some breathing space. You will calm down. You will understand the situation. And you will have a re-look at the market and take a more informed decision. If the market is very volatile and it seems that it is going out of control, then the trading may be halted for the entire day. Advantages of circuit breakers during the suspension period. Why circuit breakers are imposed? Circuit breakers allows participants to reassess the situation by gathering new information. It should not happen that they are just blindly following the herd. You will calm down, understand what has happened. And it helps in controlling the panic among the investors. Panic is very bad. Because the market is falling and your friend says, "Arey, you jaldi se sell kar do, otherwise you will lose money." You also sell. Why? Because your friend has told you. You have never bothered to check what is the basis of that information. Not only you will do that, you will also tell your own friend also. So that geometric progression of sharing of information start. Okay, if there are more and more sellers only, no buyer, what will happen to the price? Fall. It also helps exchange clearing houses to monitor their members. The exchange will also see what their members are doing, who is buying, who is selling, who is involved in this excess trading. It also helps investor to take a rational approach toward the security during the time the trading is suspended. When two people are fighting a lot, what you should do? Ask them, be separate for half an hour. Okay. After half an hour, you can start your fighting again. But then during that half an hour process, the two persons who are fighting will calm down. Think, why I was fighting? Then he will realize I was fighting for no reason. It was such a small thing. So he will calm down. Same logic the stock market has also applied. Too much of volatility means many people are fighting for the same thing. So when you stop it, they will calm down. Disadvantage is firstly circuit breaker prevents true discovery of prices for the period during which it is imposed. So some people argue that by applying circuit breakers we are not able to discover the true price of a share. Prices could have gone much high, the prices could have fallen more than what it is right. Okay. The purpose of stock market is true price discovery. But if you stop the trading only, how will I get the true price? Second line, secondly, sometimes circuit breakers prove to be unfair to retail investors. The retail investors always get a bad bargain, okay, in the stock market. Only at the time of IPO they get some discount. But there also there is a limit on the number of shares they can buy in the retail category. Sometimes circuit breakers prove to be unfair to the retail investor because well-informed investors such as foreign institutional investors usually make a move before the circuit breakers can be invoked, leading to chaos and confusion among the retail investors. The top players they take informed decisions. Retail investors take decisions in chaos and panic. Okay, because retail investor will just follow the herd, but the top investor they take a more informed decision. So all benefits whatever had to be cornered have been already cornered by the big players. So that is a disadvantage. Now we'll take a circuit break.